Businesses are sitting on trillions in unpaid invoices. I mean, your money is earned, it's just trapped. And while you wait 60 to 90 days for customers to pay, well, there's an industry that puts cash in your account by tomorrow.
Yeah, that waiting game is exactly what sinks so many growing businesses. You're staring down payroll or a massive fuel bill, and having assets on paper just means absolutely nothing if you don't have actual cash in the bank.
Right, and that's exactly why we are doing this deep dive today. We're exploring the massive and honestly sometimes pretty treacherous world of invoice factoring.
It's a fascinating space, especially right now.
Totally. And we've got a huge stack of sources to guide us through this for you. We're pulling from financial blueprints from NerdWallet and Hubble, some intense legal bulletins from the California Lawyers Association and J. Singer Law Group. Plus, we're looking ahead with some really detailed 2026 market research reports on fintech and AI.
Our mission here is to completely demystify this whole mechanism. We want to show you how factoring turns those trapped accounts receivable into instant liquidity.
Which is huge.
Exactly. But we're also going to map out the predatory traps that can absolutely destroy a business if you aren't careful. And we'll reveal how 2026 technology is automating this entire process.
Okay, so to kick things off, we really have to clear up the biggest misconception right out of the gate, because this trips up, like, almost everybody. Invoice factoring is not a loan, period.
It is not debt.
Exactly. It's like having a winning lottery ticket that only pays out in 60 days. You need cash today to keep your life moving, so you just sell that winning ticket to a third party for, say, 97 cents on the dollar. You get your money now, and they take on the burden of waiting for the payout.
That is the perfect analogy, because that legal and financial distinction is critical. You're engaging in the sale of an asset. The asset just happens to be your invoice.
Yeah, you aren't borrowing money.
Exactly. So
Yeah.
you are not taking on debt. There's no new liability sitting on your company's balance sheet. For a growing business or a startup that, simply doesn't have a 5-year credit history to show a bank, that lack of debt is a massive structural advantage.
Okay, let's ground this in reality so you can really see how the math works.
Yeah.
Say I run a logistics company. I have a small fleet of trucks. I just did a massive cross-country haul for a national grocery chain, and they owe me $50,000. But I need to pay my drivers tomorrow. Walk me through the actual math.
Sure. Let's break down the numbers from the sources. So you submit that $50,000 invoice to a factoring company. The first thing they do is provide what's called an advance rate.
Okay.
Usually across the broader market, this is 80 to 95% upfront. Though, according to the data, specific industries like trucking, they can actually see advance rates up to 97%.
Wow, 97%.
Yeah, but let's just use a 95% advance for your scenario. On that $50,000 invoice, you get $47,500 deposited into your operating account almost immediately.
And what happens to the remaining $2,500?
That gets held in a reserve account by the factoring company. Now, the waiting game shifts to them. Your customer, that national grocery chain, they pay the factoring company 30 or 60 days later.
Once that $50,000 payment clears, the factor releases that $2,500 reserve back to you, minus their cut, of course.
Right, they aren't doing it for charity.
Exactly. That cut is called the factor fee, or discount rate, which usually runs between 1% and 5% per 30 days. So if your agreed fee is 2.5%, the factor keeps $1,250 as their profit, and you get the remaining $1,250 from the reserve.
Hold on, though. I really have to push back here. A 2.5% or 3% fee for just 30 days of waiting. I mean, if I'm doing the mental math on that and annualizing it, that's an APR of over 30%.
It does sound high when you put it like that.
Yeah. Before signing a factoring contract, check Business Loan.Directory. You might qualify for an SBA line at half the cost, because that sounds astronomically expensive compared to a traditional bank loan. Why would a rational business owner agree to that?
Well, it's a great question, but you have to look at what you're actually paying for. Yes, the annualized rate looks high on paper, but factoring is fundamentally the cost of speed and access.
A traditional bank loan focuses heavily on the business owner's personal credit score, right? It requires physical collateral like real estate, and it can take weeks or even months for some underwriting committee to finally approve it.
Which you don't have time for if payroll is tomorrow.
Precisely. Factoring flips that whole model upside down. It relies almost entirely on the creditworthiness of your customer.
So because I'm hauling freight for a massive grocery chain, the factor is looking at their credit, not mine.
Exactly. If you're a small supplier selling to a massive, stable corporation like Walmart or Target, the factoring company doesn't care if your personal credit score is like a 620. They care that Walmart is historically guaranteed to pay its bills.
That makes a lot of sense.
You're paying a premium to bypass the traditional banking bottleneck. It's a strategic tool to fund explosive growth when traditional banks look at your balance sheet and just say no.
But since it's all about the customer's credit, I imagine the terms change depending on who takes on the risk if that customer suddenly goes bankrupt. The sources actually highlight a critical fork in the road here: recourse versus non-recourse factoring.
This is probably the most important distinction in the entire industry. How you structure that risk defines your cost.
Right. Let's break this down for you, because this is where you really need to read the fine print. In recourse factoring, which is usually the cheaper option if your customer goes bankrupt or just refuses to pay, you are ultimately on the hook.
Right, you have to buy that bad invoice back.
Exactly, out of your own pocket. But in non-recourse factoring, which obviously comes with a higher fee, the factoring company assumes the credit risk. If the customer goes belly up, the factor takes the loss, not you.
And beyond the risk profile, there's also the commitment level you agree to. The sources detail two main models here: spot factoring and whole ledger factoring.
What's the difference there?
Well, do you want to factor just one invoice to get out of a tight spot? Or do you want to factor your entire pipeline? Spot factoring lets you sell one-off invoices only when cash is tight. It gives you ultimate flexibility.
But I'm guessing it costs more.
Exactly. Because the factor isn't getting guaranteed predictable volume from you, they charge higher fees.
So the alternative is just handing over the whole pie.
Yeah, whole ledger or contract factoring means you agree to sell all your accounts receivable to the factor for the duration of a contract. You lose that flexibility to pick and choose, but you gain highly predictable cash flow and significantly lower fees.
Looking at the specific industries that rely on this, the scale is just mind-blowing. Trucking, like we mentioned, is massive. You've got drivers who need cash daily for diesel, maintenance, and their own paychecks, but freight brokers notoriously pay in 30 to 60 days.
A huge pain point for them.
Oh, totally. And the sources show that factoring companies in logistics now use dedicated mobile apps. A driver can literally just scan a bill of lading from the cab of their truck with their smartphone and get funded the same day with those 97% advances.
It literally keeps the supply chain moving. And government contractors are another perfect example where this is practically mandatory.
Because the government is slow.
Extremely slow. The government is essentially a risk-free debtor. The U.S. Treasury is going to pay its bills. But they are notoriously, painfully slow due to bureaucratic red tape. A contractor might wait 90 or even 120 days for a federal invoice to clear.
Wow.
Yeah, so factoring allows these contractors to maintain the liquid cash required to meet things like the 65% Buy American thresholds, which requires buying domestic materials up front without running out of operating capital before the government check even arrives.
We also see this heavily in healthcare and staffing. Imagine running a specialized IT staffing firm or a travel nursing agency. You have to cover weekly payroll for hundreds of high-earning nurses, but you're waiting months for enterprise hospital networks to clear your invoices.
Right. Factoring bridges that massive chasm between when you have to pay your people and when you actually get paid for their work.
So we've established this is an incredibly powerful tool when used correctly. But reading through the legal bulletins from the California Lawyers Association and J. Singer Law Group, there is a very dark side to business financing when owners get desperate.
Yes, there absolutely is.
Because when a severe cash crunch hits and an owner doesn't fully understand factoring, they often fall into a trap that looks similar but is fundamentally toxic. Merchant cash advances, or MCAs.
And we really need to draw a very thick line here. MCAs are a completely different and far more dangerous beast.
How so?
Well, unlike factoring, which buys a specific verified invoice for work you have already completed, an MCA funder advances capital in exchange for a percentage of your future daily receipts.
So money you haven't even earned yet.
Exactly. They are betting on the future. And to collect it, they set up daily or weekly ACH debits directly from your business bank account.
And the math on these can be absolutely devastating because they take a fixed daily amount regardless of what your actual profit margins are for that week. It drains cash flow aggressively.
Right.
Say you own a restaurant. The MCA takes a fixed amount based on an estimate of your sales. If you have a slow week because of a blizzard, they don't care that fixed withdrawal still hits your account, potentially zeroing you out. The sources calculate that the effective annual interest rates on these MCAs can exceed 300%.
Which inevitably leads to what the legal sources call MCA stacking. A business gets drained by the daily debits of the first MCA, so they get desperate and take out a second one to cover payroll, and then maybe a third.
Just a total death spiral.
It really is. Suddenly, 20 to 40% of their gross daily revenue is being eaten by automated withdrawals before they can even pay rent or buy supplies.
Which brings us to the most draconian enforcement mechanism detailed in the legal briefs, the Confession of Judgment, or COJ. I was reading this and my jaw just hit the floor. I mean, this shouldn't even be legal.
It is one of the most aggressive legal tactics in corporate finance, designed specifically to bypass the judicial process entirely.
Imagine signing a contract that contains a COJ clause. It says that if you miss a single payment on your advance, the lender can instantly freeze your business bank accounts and seize your assets.
Without a hearing.
Right. They don't have to take you to court. They don't have to prove you defaulted to a judge. They don't even have to notify you. You just wake up one morning, try to run payroll, and your accounts are locked. If you ever see a confession of judgment clause in a contract, our sources are screaming at you to walk away immediately.
But there is genuinely good news on the legal front here. The justice system is starting to catch up to these predatory tactics. Federal bankruptcy courts are actively fighting back.
Really? How so?
The sources highlight a recent case down in Houston, in Rianna, which is a landmark shift. Judges are increasingly looking at the actual mechanics of these MCAs and ruling that they are not purchases of future receivables, as the contracts claim. They're actually disguised loans.
So if they're reclassified as loans by a federal judge, does that completely change the rules they have to play by?
Entirely. This is the linchpin. If an MCA is legally deemed a loan, it immediately becomes subject to state usury laws.
Okay, and those cap interest rates, right?
Exactly. Usury laws cap the maximum allowable interest rate a lender can charge. Because MCAs often carry effective interest rates of 100, 200, or 300%, they aggressively violate these caps. When a court determines this, the agreement can be entirely invalidated, and those predatory funds can sometimes even be clawed back from the lender.
That is huge for small business protection.
Yeah.
And the regulatory pushback isn't just happening in federal courtrooms. The California Lawyers Association Bulletin details Assembly Bill 483, which goes into effect in August of 2026.
That's a big one.
Yeah. This law specifically targets the long lock-in contracts and hidden penalties that lenders use to trap businesses. It legally caps early termination fees on fixed-term installment contracts at 30%. It's a massive step to stop lenders from trapping consumers in endless debt cycles.
What's truly fascinating is that this regulatory evolution is happening perfectly in tandem with a massive technological disruption. The fintech sources from our 2026 stack show that technology is actually fixing the root cause of the desperation that drives people to MCAs in the first place.
Which is the speed of accessing capital, right? I mean, BusinessLoan.Directory shows you factoring, SBA, credit lines across 75-plus lenders in under 2 minutes, soft pull, no credit hit. It's all about moving faster now.
Yeah.
Nobody wants to deal with fax and physical invoices or waiting days for a human credit check.
Exactly. The keyword dominating the 2026 fintech reports is embedded finance. Factoring is essentially becoming an invisible capability.
Invisible how?
Well, embedded finance means factoring isn't a destination anymore, it's a feature. Lenders are embedding factoring APIs directly into the accounting software you already use every day, like QuickBooks and NetSuite.
So instead of logging into a separate portal, you generate an invoice for a client right there in your software, and there's just like a button next to it that says, "Get paid today."
That's exactly how it works. And what's operating behind that button is agentic AI. These AI modders are conducting complex real-time underwriting in seconds.
Wow.
When you click that button, the AI instantly pulls historical payment data, cross-references commercial credit databases to see if that specific customer usually pays on day 30 or day 45, and issues an approval. The sources show this AI-powered underwriting is cutting approval times by 80%.
So a process that used to require a human underwriter taking 3 days now takes about 3 minutes. But with capital moving at the speed of an API click, what about fraud? One of the biggest historical risks in factoring has always been a business owner acting in bad faith and selling the exact same invoice to 2 different factoring companies to get double the cash.
Right, that's known in the industry as the double pledging problem, and it has historically caused massive losses. But it's currently being solved by blockchain technology. In 2026, we're seeing the widespread adoption of tokenized receivables.
Okay, let's unpack that jargon for a second. What does a tokenized receivable actually look like?
Think of a tokenized invoice, like a unique digital fingerprint for that specific bill of goods. When an invoice is created, it's stamped onto a decentralized blockchain ledger. Because it has that unique cryptographic fingerprint, it is physically impossible to photocopy it or digitally duplicate it to hand to two different factoring companies.
Ah, so it creates completely transparent real-time verification.
Yes. Furthermore, smart contracts on the blockchain can trigger the funding automatically the absolute second the delivery of goods is verified, say, by GPS data from a logistics truck hitting a loading dock. You can't sell the same token twice, which effectively eliminates double pledging fraud cold.
It's brilliant. It completely removes the trust issue from the equation. And while technology is solving that trust issue, there's still a massive administrative bottleneck when it comes to the actual independent contractors doing the work, the paperwork. And that's exactly what the sources say that OBBA is designed to obliterate.
Ah, yes, the One Big Beautiful Bill Act.
It sounds like a joke from a sitcom, but it is a very real, highly impactful 2026 tax update from our sources that has a massive ripple effect on this entire financial ecosystem.
It absolutely does. The OBBA fundamentally alters back-end reporting requirements for businesses of all sizes. Starting in 2026, the IRS reporting threshold for 1099 NAC and 1099 MIC forms is jumping significantly, from $600 up to $2,000.
To translate that tax jargon into real-world impact, it used to be that if you paid a freelance graphic designer or a contract driver just $600 over the course of an entire year, you had to file a 1099 tax form for them.
Right, which was set decades ago.
Yeah, it hadn't been updated for modern inflation at all. Tracking those micropayments was an absolute administrative nightmare for small businesses. Now you only have to file if you pay them over $2,000. This massive reduction in paperwork makes it vastly easier and cheaper for businesses to utilize independent contractors.
It drastically smooths out B2B payments, which, lubricates the exact cash flow ecosystems that factoring is designed to support. Less friction on the administrative side means faster deployment of capital and faster growth.
And faster growth requires reliable liquidity. That's the through line connecting all of these sources. Technology, judicial rulings, and new regulations are finally aligning to make capital more accessible, faster, and critically safer for the actual businesses that drive the economy forward. So what does this all mean for you? It means you need to stop looking at your unpaid invoices as just a frustrating waiting game. They are an active asset. Whether you are scaling a 50-truck logistics fleet or building a tech startup, factoring offers a legitimate way to unlock your earned money today without taking on crippling debt.
But you have to be smart about it.
Exactly. You have to navigate around those predatory MCAs that want to drain your daily revenue. You have to read the fine print to understand if you are signing a recourse or non-recourse agreement. And if you ever see a confession of judgment clause buried in a contract, run the other way. Go to BusinessLoan.Directory right now, see what you qualify for, free and fast.
This raises an important, almost philosophical question, though, as we look to the horizon of this technology. We discussed how agentic AI and blockchain are removing fraud and underwriting delays.
Right.
If these systems continue to evolve, if we reach a point where AI can analyze global supply chains and predict exactly when a customer will pay an invoice with 99.9% accuracy, does the fundamental credit risk of factoring completely disappear?
That is a wild thought. Because if the risk for the factoring company essentially drops to zero, will the cost of factoring eventually become completely free? Imagine an economy where the waiting period for earned money just vanishes entirely.
It would fundamentally change the nature of money and time in the global economy. It redefines what it means to do business.
It really does. Well, if this saves you time, hit like and subscribe. New deep dives every week on business financing stuff your banker won't tell you.